So today's discussion topics, let me sort of focus on some of the questions many folks have been asking. When is the right time to sell assets? Is it now the right time, or a year from now, 2 years from now, especially for the deals that were funded a couple of years ago? Some of them in commercial real estate are struggling. So the big question is, when can they exit? When do you maximize the recovery or return potential to investors? So from a timing perspective, now is clearly not the best time to sell. Recording this right before Fed rate cuts going to materialize this week. So we're just waiting on the Fed rate decision, quarter or half a percentage. Doesn't matter which one it is. It's the first one. It's a move in the right direction. A lot more to follow. So feel very cautiously optimistic, light in the tunnel. For sure, we are finally coming off. The Fed is taking the foot off the brake, and we'll see some improvement as a result of that. As far as is now a good time to sell, clearly not. So if you're a seller in this market, you're selling in essence as an act of desperation because you don't have the cash, you can't raise the cash, you don't have too many options. So the sellers today are sort of basically distressed, motivated sellers. And if you have to sell today, it's kind of not an ideal scenario. Typically, it's out of a bad conditions, out of bad need, liquidity stress, etc. If you're a buyer, of course, you want to buy now if you can get a great deal. So buyers of today are kind of bargain hunters, while the sellers are folks that don't really have too many good options. So, but now let's forward into 6 months from now, a year from now, year and a half from now, 2 years from now, and longer. So, a lot depends on many factors. Of course, we don't know where things will go. Will we have a soft landing, essentially avoiding a real recession, or are we going to see a significant recession? One way or the other, Fed is going to cut rates. How much they're going to cut will depend whether it's soft landing or real recession. Real recession, they're going to cut faster. Let me just remind you, on the way up, they increased interest rates at very fast and furious speed. They basically did in 1 year about 400 basis points, 4% of Fed funds rates increase, and then they followed that with a little bit more in a few more months, and basically reached terminal velocity at 5.25 to 5.5, and they moved it from about a quarter. So they moved the interest rate up total on the way up 5.25%, from zero essentially to 5.5 or 5.25, depending how you count it. So all that was very fast. Are they going to cut as fast? Well, they would cut like this if we had crisis. If we don't have crisis, they're not going to cut that fast for sure. So again, we're talking about soft landing and some kind of potential recession. So I don't expect them to cut extremely fast. But it's certainly possible that over the next 6 months, we're going to see easily 1% cut in the Fed funds rate. It's not difficult to see. Now it's September. The next meeting is in November, post-election. The following meeting is in December. By the way, post-election, there will be less political pressure. There'll be more data-driven, and just move forward as they need to based on the economic data and no political pressure. They're supposed to be independent anyway. So if we are talking about how many cuts can happen in 6 months, we could easily see 4 quarter cuts, possibly more. So if you do the real basic math, we could be in a meaningfully improved Fed funds rate environment in 6 months. In a year, that number could be 2%, could be 1.5%. It all depends on how the data points out. But it wouldn't be out of the question for the Fed funds rate in, let's call it a year, to be down 1.5 to 2%. And then they'll likely continue. It's not the end of the cuts. I think the terminal velocity, of course, we don't know now. It's going to depend on many data factors. Will inflation come back? Will the government go and print a lot more money? We don't know those factors. But from a, call it terminal velocity, the normalized rate on a Fed funds rate could easily be 3%. So we could have another 2.5% to cut, maybe even 3% to cut from the current rates. So that gives us plenty of room. And if you give it enough time, we're likely to get there. With a full disclaimer, your guess is as good as mine. So terminal velocity could be 3% on a Fed funds rate, 2.5%. Could be higher, could be lower. Depends on what happens in the economy. But why am I sort of going in this direction? Well, the reason I'm going there is the market conditions will be significantly better in that environment. So patience is a virtue. Not selling the property today and waiting out and working on maximizing the value of the property, renovating the property, improving occupancy, maximizing NOI is what folks should focus on, and buy the time. How do they buy the time? Well, it's if it makes sense for the right deal, they can bring in mezzanine debt, even though it's expensive, but it buys critical time where it increases in value due to the interest rate cuts and cap rate compression could be very, very significant. So 1.5 to 2 years from now, in my view, is sort of optimal time. At that point, the interest rates could be reaching the bottom of the cycle, and the valuations could be significantly at a better place. Could there be a good opportunity to sell in 6 months? I think it's going to be better than now. What about 12 months? For sure. So again, give it more time, the better the opportunities to sell in a better market. That's kind of the general thesis. And the specific sort of optimal opportunities, highly speculative statement, about 1.5 or 2 years. So most of the mezz deals that we underwrite in our Tempo Advantage Fund, we're focusing on approximately 1.5 to 2 years. That time frame should be roughly sufficient to complete all the necessary work and to bring these properties into the market with a much better valuations, much better pricing, much better availability of credit, etc. So that's the answer to the question. About 1.5 to 2 years is optimal, but there may be good opportunities to bring these assets to the market sooner. So if you're an investor that wrote a check a few years ago, you got to be patient and understand that time is actually on our side, on the investor side, if you are an existing investor. If you are a buyer, you're trying to buy as soon as possible. But if you are a seller, you definitely want to take your time, improve the assets, maximize the value, and bring into the market when the interest rates at a much lower point. That's the wrap. Appreciate you listening. Until the next time. Thank you.